Welcome to our 2020 outlook. Throughout this current bull market, which is up 400% over the last 11 years, several prominent market bears have been calling for a stock market crash. Our issue isn't that their forecast has been incorrect. We readily admit forecasting markets is difficult. Our issue is their insistence that their thinking is correct and the bull's thinking is foolish. The self-assuredness of bears has kept many investors from participating in this bull market. Even when markets do eventually correct, the damage of not having equity exposure during this bull market will easily outweigh any benefit of avoiding a pullback in stocks. We don't see a recession in 2020. There is no shortage of unforecastable external shocks that can shake the economy and create a recession. But when we view the economy in a vacuum, it is extremely unlikely we would see a recession. A recession is defined as 2 consecutive quarters of negative real GDP growth. Consensus GDP forecasts for 2020 are solidly positive. The more important question is, will real GDP growth slow in 2020, not whether we technically have a recession. We are hard-pressed to find the reason for a slowdown in growth. Of course, the Fed could disrupt things with an unexpected tightening, lest we forget Q4 of 2018. Some sort of real scandal could emerge. Uncertainty, or perhaps too much certainty, about the political election could create some angst. However, if we look past all the cable news headlines, we continue to see corporate profits rising, led by revenues, which are being led by a healthy U.S. consumer. Despite the lack of recognition in the financial headlines, productivity has been making an impressive comeback. This continues to fuel margins and keep wage inflation at a rate that inspires workers to work and employers to employ. The primary argument from the bears continues to be that valuation is too high. Currently at 17.5 times earnings, we'd argue it might be too low. So long as inflation and interest rates remain low, despite current valuation multiples being slightly higher than long-term averages, multiples are justified since the present value of those earnings is also higher. So the next thing we should check on is that inflation, and therefore interest rates, will not move materially higher. Much like we are still waiting for the recession that we were promised, countless experts have been warning about the return of inflation. Ironically, even with the Fed doing everything possible to create inflation, they are unable to consistently achieve their 2% inflation goal. We have been promoting a buy local strategy for quite some time now. We believe in supporting our local businesses. During a moment of weakness, we pulled back on our buy local strategy and went from underweight to neutral on European equities. We quickly regretted the decision and returned to our domestic overweight. It's so tempting when valuation is cheaper overseas and the U.S. continues to outperform to rotate into international stocks. The problem is and continues to be that this is a value trap. The reason the U.S. continues to outperform and justify their higher valuation is that it is a much better economy. We continue to believe that there are structural reasons for this and that the outperformance doesn't necessarily need to mean revert anytime soon. Deregulation and less bureaucracy, unilateral trade deals, and a more favorable tax policy relative to the rest of the world means the U.S. economy is producing more profit and growing faster than other developed nations. A point that is seldom mentioned but is very important is demographics. The U.S. working age population is increasing while Europe and Asia are decreasing. The evidence is unambiguous that aging populations spend less, which hurts economic growth, while also draining the economy through the use of government resources at a far higher rate. We are not suggesting the twisted economic utopia idea of permanent vacation at a certain age, primarily because of our own age, but old people definitely hurt economic growth. Successful investing is about avoiding big mistakes. While this is most often associated with taking on too much risk, the reality is the biggest mistake investors make is not being invested for long-term success. We are much more confident in our market forecasts over the next few years than over the next few weeks. One of Momartz Mahaney's core beliefs is that investors should be invested at all times. We have and expect to continue to add value by tilting portfolios in favor of undervalued asset classes. However, at no point will we recommend not being invested. Thank you, and we appreciate the opportunity to work with you.